The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Good morning and welcome to Squawk Box Europe. I'm Juliana Tattlebaum and these are your headlines. Sanae Takaichi is elected as Japan's first ever female prime minister after striking a coalition deal with the right-wing Japan Innovation Party. Global equities stage a comeback rally as fears over credit risks in the U.S. ease, and investors look ahead to this week's corporate earnings and a potential trade truce between Washington and Beijing. And European leaders rushed to Volodymyr Zelenskyy's side following Friday's tense White House meeting with President Trump, with Zelenskyy now set to visit London at the end of the week for talks with the coalition of the willing. A very good morning to you. Let's get straight to our top story. Overnight, Sanae Takaichi has been elected as Japan's first female prime minister in a vote of the country's lower house after agreeing a coalition deal with the Japan Innovation Party, also known as Ishin. Let's get out to Kaori, our colleague who joins us now from Tokyo. Kaori, very good morning to you from London. A historic day for Japan, the election now of the first female prime minister in the country's history. What now? Where will attention now turn?
Well, good morning. This is a historic day for Japan, and Sanae Takaichi is on her way to becoming the 104th Prime Minister of Japan. There's a formality still left. By nightfall here, she will be headed out to the Imperial Palace, where the Emperor himself will appoint her as the new Prime Minister. But it's been such a rocky ride over the last 2.5 weeks. At one point, it wasn't really clear whether she would make it this far and actually clinch the premiership. But at the end of the day, she did get on board late last night the right-leaning small party called Ishin. And when you look at the final votes in the lower house, she managed to add on 6 votes from the independents to avoid a runoff vote. So this is a very, very shaky coalition. It's a new coalition. It means with this minority government, getting anything done in parliament is going to be a slog, and there's going to be a lot of negotiation with the opposition parties as well. I initially thought that today would be a historic day for 2 reasons, not just for Takaichi, but maybe because the Nikkei 225 might surpass 50,000. It got very, very close to that, a whisker of that, but now has erased most of those gains. But I think, Juliana, there is going to be another historic moment later on today because the finance minister could also be a woman, and that would be a first for Japan.
When it comes to the Premier's spending plans, that's certainly been a focal point from a market perspective. How does she think she's going to finance her fiscal plans? And talk to us about the importance of the appointment of this finance minister.
Yeah, well, she's a fiscal dove, no doubt about it. And the finance minister that she's likely to appoint is also a fiscal dove. And she has been calling for big blanket spending to try and grow the economy, very much in the mold of her mentor, Shinzo Abe, the late prime minister. But the Bank of Japan has made it clear that it's not going to buy up all this debt. So you can't print and print your way towards growth. So I think at the end of the day, at least in the very short term, she's going to be hampered with the markets dictate as well. I mean, look at the spike and the gradual increase that we've seen in the JGB yields, particularly on the long yen, that is worried about this fiscal indiscipline. And I think when you have JGBs moving higher to the level that we are, that may determine in the short term whether or not she can embark on some of these plans. I think the other question is perhaps an agreement that she made with this small coalition party to potentially freeze the sales tax on food items, which have been the price of which have been going up very sharply over the last year. And there's a question of how they're going to fund that loophole as well. And not to mention, of course, defense spending is going to be big. I mean, she is a hardline conservative, and she has always advocated a bigger role for Japan's military. And with the upcoming trip by U.S. President Donald Trump, who has also been very vocal about Japan playing a bigger part in its own defense, I think that issue could be coming up as well. So I think, the markets have had these 2 waves of the so-called Takaichi trade. I think now they're going to, look at the policies that they're practically able to implement, especially because the road to this point has been so difficult for her.
Cowrie, thank you for the roundup. And indeed, President Trump poised to kick off that Asia trip at the end of this week. So we'll no doubt be catching up with you when he makes his way to the region. Now let's get to Ritika, who's going to walk us through all the market action. Ritika, the Nikkei 225 looks like it's close to flirting with that psychologically important 50,000 mark.
Yeah, Juliana, we got to kick it off with the Asian markets there. As you mentioned, Japanese equities very much in focus. The Nikkei up nearly 0.3%, close to that 50,000 mark. As you mentioned, this is, as we talked about, Sanae Takaichi being elected as the first prime minister, a female prime minister in Japan. We know she's pro-stimulus, pro-monetary easing, so all of that is providing a boost to equities over there. I also want to point you to the Hang Seng there. You see up 1.3%. There is optimism building around a China-US trade deal down the line, so that is all helping a risk-on picture over there in Asia. We flip up the board though and take a look at how futures are faring over here in Europe. We can see it's a mixed picture, maybe just taking a breather after what was a strong rally yesterday led by those defense names, some of those bank names. Investors are going to be watching earnings trickling in this week. Some of those big European lenders in focus. You see the FTSE futures up just 0.1%. Finally, let's flip it over to Wall Street, which had another strong day and what was a broad-based rally. The S&P 500 closed up above 1%. The Nasdaq closed up 1.4% higher. This was helped, no doubt, by the shares of Apple that hit a new record on an upgrade from Loop Capital, actually their first record of the year. And as earnings continue to trickle in, one of those, Juliana, was Zions Banks, one of those regional banks in focus over those bad loans. But they have earnings that beat expectations. So investors looking past the recent troubles and investors are going to be keeping an eye out on more earnings coming today. We see U.S. futures just flat at the moment. But again, those earnings are going to be in focus. Netflix is going to be up next.
Ritika, thank you for walking us through all the latest. You mentioned shares of Apple. We'll just flesh out that story for you. Shares of Apple hit a new record high after a report pointed to a strong pickup in iPhone sales this year. Research from Counterpoint said the tech giant's iPhone 17 outsold the previous model by 14% in the first 10 days after its launch, with a spike in sales in both of Apple's core markets, the United States and China. Let's welcome Thanos Papasavas, founder and CIO of ABP Invest, for his take on markets. Thanos, always great to have you.
Thank you very much, Julianne. Always a pleasure.
Looking forward to the conversation. I'm curious to kick off what you think about the major comeback we've seen this week in markets. Just a few days ago, we were talking about credit concerns and the risk that we could be entering a credit crisis. And it seems like those concerns are long gone now.
We had our monthly inset in the beginning of October, and we had our latest monthly scorecard at the end of September. And our analysis was pointing to a solid, positive picture. So when we wrote our analysis to our clients, we basically said, guys, we're worried that we're not worried enough in terms of what's happening in the markets, because we do not agree with the concerns of the Fed. We do believe that there's an underlying positive economic picture coming out of the US, despite the weaker employment data. So we are constructive, and we have maintained a risk-on strategy since the 7th of April of this year.
So you think it does make sense that markets use it as a buying opportunity?
We do think it makes sense. It is a little bit uncomfortable, obviously, given where valuations have been in momentum, but valuations are very expensive in the US, supported by underlying fundamentals, market price behavior, politics and geopolitics support that. So we are neutral to the US market with a preference for healthcare, but outside of the US, we're positive China, positive Japan, Europe, UK, and even the 12-day war, during the 12-day war in June, which are positive Korea, Turkey, Central Eastern Europe. So we believe that there's an underlying element of a strong, resilient, and strengthening US economy, but it's not just about the US economy. Europe, fiscal expansionary policies. Asia has been doing much better.
There had been so much jubilance around the European story earlier in this year, and it's sort of petered out a little bit. Clearly, there are still days like yesterday where the Xetra DAX powers to, I think, its best day since May. We had a massive rally in defense names. What do you think is going to be the next catalyst for the European story?
So there's a positive element and a concerning element. The positive element, as we can see with France, we see it as an idiosyncratic risk. We don't think that the France developments are similar to what we had a few decades ago with Italy, Greece, Spain, and Portugal. So this is isolated, and we can see that with the spreads of Italian BTPs over bonds, very stable. So France in itself is not a concern. Should that deteriorate a little bit, the Europeans have the measures in place to be able to take control. So that is not a concern. That's fine. What is concerning is if you like, a time bomb should the politicians not address the far right-wing parties, especially in Germany, where AfD is the highest polling party. Unless the politicians open up that conversation and engage, then we were concerned that in the next economic downturn, that will start to create social unrest and real economic impact. It's not a consideration for now. It is something that we're aware of, and we hope that the politicians will be able to address it. AfD is no longer 3 to 5%. It's 26%, closer to 30, similar to the RN in France. So that conversation, I think, has to be had.
But you are still constructive on Europe. So what's going to drive the gains before we potentially enter this,
totally.
Scenario
First
you
of
just
all,
described?
we have upgraded our economic outlook from 55 to 60% on the back of the necessity. The Europeans finally realized that they have to take ownership of their geopolitical and geoeconomic strategic presence, and they are doing that. Interestingly, although we're positive European equities, which we are, we're no longer positive the euro. We closed that view because we believe that the dollar may start to see a little bit of a recovery. So
I think you're up 12% versus the dollar this year.
Exactly. So we reduced that, we downgraded the positive euro, but we have maintained our positive Bund, German Bund, as a diversifier. And the reason why we maintain the German Bund, even though we are expecting and seeing the fiscal expansionary policy, is because of our trust on the Bundesbank. We believe that at the end of the day, the Bundesbank will be there to ensure the politicians and policymakers do not deviate too much from fiscal prudence and orthodoxy.
Let me ask you about equities within Europe. How do you think about the sectors here? Are you bullish on the sectors that have been favorites this year, the defense names in Germany, for example?
We do not have a specific sectoral preference in Europe as we do in the US. In Europe, the way we express it, we have a geographic preference. So we prefer Central Eastern Europe, which we believe will benefit from both the fiscal expansionary policies and the shift in defense, in infrastructure, in manufacturing, which are taking place in Europe, but also the eventual reconstruction of the Ukraine, which we expect will start over the next sort of 24 to 36 months, and that will also benefit Central Eastern Europe. And of course, valuations. Valuations are attractive in Central Eastern Europe. They also remain attractive in Europe.
Really interesting that you mentioned the reconstruction aspect, because that seems to be what offers a nice mitigating factor for the defense names. Every time there's a headline suggesting that we might get resolution on Ukraine, there's one camp that says this is actually negative for the defense names in Europe. But on the other hand, it's positive because of all the reconstruction that'll be needed and the industrial impetus that will bring.
Totally. I think this is where the Europeans realize that they cannot just rely on the U.S. defense presence. They do need to beef that up, and there is significant amount of investment which needs to be taking place, not just in the defense sector per se, but also in the broader infrastructure which supports it.
Let me just come back to your first point that you are more bullish on regions outside of the U.S., but still you sound pretty confident around the U.S. economy. What's the risk that if we do see the Fed continue down its rate cutting path, that leads to an overheating of the U.S. economy and actually turns out to be a policy mistake?
That is very much our concern. We disagreed with Powell in August with the Jackson Hole because he sort of reprioritized, if you like, inflation with employment, and that continued in September, leading to the rate cut. We agree that the labor market is weaker, no doubt about that, but the overall level of unemployment is still relatively low at 4.3, number one. Number two, if we look at the other broader sectors of the economy, whether it's industrials, corporates, consumer, housing has stabilized, economic growth, PMI, OECD, LEIs, all of those are constructive. So we agree the labor market is off, but with interest rates where they are, corporate profits on a front foot, we do not believe that the probability of a recession has increased, and therefore we don't agree with the Fed's rate cutting strategy or expectations. If we were to see, and this is the risk if you like, if we were to see the continuing of the pickup of inflation, going up towards the upper end of the 2.5% to 3.5% range, whilst the economy is doing well, we believe that the Fed will have to bring back those rate cut expectations. If the economy is strong by that moment, I don't believe that the equity market is going to have any significant correction because it will be supported by strong economic growth. The risk for the equity market is if we see a pickup in inflation without the commensurate rise in the economy.
Right.
But that's a low probability.
Thanos, thank you for joining us this morning. Thanos Papasavas, founder and CIO of ABP Invest. Coming up on the program, Amazon Web Services recovers after a major outage Monday sparks fears over another CrowdStrike type incident. Plus, streaming giant Netflix reports after the bell today, with options markets eyeing a whopping 8% stock move in either direction. We'll be right back. Welcome back to the show. Ukrainian President Volodomyr Zelenskyy described his meeting with President Trump last week as positive, in contrast to media reports which painted the talks as volatile. Ukraine is set to purchase 25 Patriot air defense systems, although Kyiv failed to secure the highly coveted Tomahawk cruise missiles. Trump backpedaled on his support for Kyiv after saying in September that Ukraine could take back all of its territory and even go further into Russia, now calling for a ceasefire on current lines. Speaking to reporters, Trump said that he finds it doubtful Ukraine could win the war.
They could still win it. I don't think they will, but they could still win it. I never said they would win it. I said they could win. Anything can happen. You know, war is a very strange thing. A lot of bad things happen, a lot of good things happen.
Europe's top diplomat, Kaja Kallas, said that it was, quote, not nice that President Putin, who faces an arrest warrant from the International Criminal Court, might meet Trump in a European country. Speaking to reporters, Kaya said Trump's efforts to end the war in Ukraine are welcome, but that the Ukrainian president must be present. The EU's foreign policy chief also added that a 19th package of sanctions against Moscow is expected to be agreed this week. Zelenskyy is set to travel to London this Friday for talks with Europe's coalition of the willing ahead of the expected Trump-Putin summit in Budapest. In a post on social media, the Ukrainian president said there would be many meetings and negotiations in Europe this week as he attempts to win security guarantees. UK Chancellor Rachel Reeves is expected to use a speech at the government's Regional Investment Summit in Birmingham to promise a, quote, blitz on business bureaucracy in a plan she expects to save businesses £6 billion per year. Reeves is expected to announce changes to antitrust processes as well as proposals to scrap what she describes as pointless paperwork for small businesses. The ICAEW, which represents accountants in England and Wales, says more than half of business would respond to budget tax rises by cutting staff or freezing recruitment, warning of an investment cliff edge. Soren Thiru is economics director at the ICAEW and joins us now. Richika is also going to join for the conversation. Thank you for being with us as we all brace for this November 26th budget. So much anticipation, so many sort of leaks, speculation in the media around what Chancellor Reeves may or may not announce. What does the business community want to see from Chancellor Reeves come November 26th?
Well, certainly what we're seeing at the moment is the budget next month is casting a long shadow over the economy. And we're seeing that in some of our research, which you mentioned, where if there are more tax rises in next month's budget, we could see recruitment fall further, investment as well fall further, but also prices increase as well. So it has wider impacts for the economy. I think one of the sort of big challenges businesses are facing at the moment is that the wider environment is far too uncertain for them to plan and invest over the long term. It's also too expensive to do business as well. Tax is a huge issue for business, but also other issues like energy costs is also dragging on business sentiment more widely. And it's also more difficult to do business as well. The level of regulation is a big challenge. I started saying Business Confidence Monitor suggests that regulation is the second biggest issue for businesses are facing at the moment. So that's clearly three big challenges that we need the government to address in next month's budget.
The Chancellor says over and over again that this government is committed to growth, and that's what's driving the Labour agenda. What would prove that the Chancellor is really committed to growth?
Well, unfortunately, while the government do talk about going for growth, unfortunately, a lot of their policies are against that. We see that in a number of ways. We saw the national insurance increase having a huge impact on businesses. Our own data shows that 80% of businesses were negatively impacted by that. So I think what businesses need is a clear plan to drive growth and productivity as well, because there are going to be two big challenges that come out in the budget, because we expect the EOBR to downgrade their forecast of productivity. That causes huge issues for public finances. So the government needs to have a clear and credible plan on how to deliver growth over the long term. That means nationally, but also locally as well.
Surin Ritika here, just jumping in. Which sectors, when you speak to businesses, which sectors do you think are going to get hurt the most if the Chancellor does indeed raise taxes on businesses?
Well, our data suggests that there are certain sectors that are really going to be impacted, particularly retail and construction. And we're seeing sentiment in those sectors particularly weak because the nature of their workforce and the businesses they operate is that they're more exposed to some headwinds, particularly domestically, and they change the tax system and insurance rise is a big example of that. So our data suggests that if, for example, there were more tax rises in next month's budget, the construction sector and retail were more likely to cut jobs, for example, than maybe some other sectors. But clearly, seeing that having an impact more widely as well. We're also seeing, when you look at wider business sentiment, is that sectors such as property are also particularly weak at the moment. And that is also linked to both the regulatory environment, but also concerns over more tax rises in next month's budget as well.
Surin, do you think businesses would be able to absorb at least part of the higher costs if they do get further tax rises down the line? Or do you think this is going to lead to higher prices eventually for the consumer?
Well, I think what we're seeing at the moment is that businesses are taking quite a mixed approach. So some businesses are looking to absorb at least some of those costs, high costs in low profit margins, for example. And I think that's why we're seeing, for example, business sentiment falling over the last few quarters. But we're also seeing more and more that businesses are reaching a bit of a tipping point where because they can't absorb, there's only so much they can absorb in their own business operating model. So we're seeing that sort of filter through into higher prices, weaker investment. We're seeing cut investment in staff training falling as well. So I think it's seeing businesses struggling to adapt to these higher costs. And if there are more tax rises in next month's budget, you can see the situation only get worse, particularly around recruitment.
When it comes to recruitment, what is your sense, based on your conversations, your surveying of the business community, around whether there are enough of the right kind of workers in the UK?
It's a fairly mixed approach. I think businesses are still saying that they are trying to get some levels of types of employees, particularly in certain sectors. I think construction is a sector where there's still an uphill struggle to get staff. But the issue is at the moment, and we're seeing this in the official data as well, is that demand for labour is actually falling because of the wider economic issues and obviously cost pressures. The cost of employing a person has obviously shot up over the past year. So what we're seeing, counter to the issues around getting staff and getting the right type of staff, actually that's being sort of superseded by weaker demand because of the high cost pressures and wider weakening in economic conditions.
When you listen to the Chancellor's latest commentary, she used a speech at a summit in Birmingham just this week to talk about her blitz on business bureaucracy. To what extent is that the problem, and to what extent is the suggestion around cutting some of this red tape going to unlock some of the growth that she's looking for in the UK economy?
Well, business already tell us that it is pretty difficult to do business, and that's due to a number of factors. There's obviously the wider big picture regulation stuff that's really difficult for businesses. Our own data shows that concerns over regulation is at a 7-year high at the moment. That's clearly a concern. What we're also seeing is issues with, for example, the tax system, where that's overly complex. There's multiple VAT rates, for example. Trying to understand that is a big issue for businesses as well. So any action that we certainly welcome, but I think what businesses are looking for is not so much, is obviously partly is less regulation, but also more flexible regulation and more advice and more sensible regulation. So it's not a barrier to growth, actually helps facilitate growth.
Surin, when you're talking about growth here, what is one policy that you think Rachel Reeves should deliver in her budget to deliver that growth, and for the long term as well, instead of just a short-term kind of a measure?
Well, but what businesses are looking for is the wider environment to help try and facilitate them to invest, recruit, and innovate in new technology, for example. So I think what businesses are looking for is a more certain picture going forward. So what we would like the government to do is commit to no more new business taxes for the rest of this parliament. because by doing that, you're giving businesses the certainty to plan for the future, and that will hopefully kickstart things like investment in particular.